The tech press celebrates every new funding round like a finish line. The headlines announce millions raised, and it is easy to assume that pulling in outside capital means a company has made it. Venture capital operates as a specialized financial product, designed primarily to maximize returns for the investors providing the liquidity. Founders with a working product face a stark choice: preserve ownership and grow through revenue, or sell pieces of the company to buy aggressive speed. External capital alters the structural DNA of a business. Priorities, timelines, and the definition of a successful exit shift the moment the check clears. The expectation on the left shows a clean trajectory: idea, safe, Series A, then IPO. The reality on the right shows founder ownership shrinking and failure rates remaining high. Ultimately, the founder holds a minority share, answering to an external board. Seeking outside funding is a permanent trade. It exchanges absolute autonomy for extreme velocity. Bootstrapping keeps the idea stage grounded in personal savings, side income, or consulting revenue. Relying on internal cash flow forces a narrow focus on product validation, acquiring real customers, and achieving early profitability. This path results in slower growth, as expansion relies entirely on the capital the business can generate and the founder's personal financial risk. In hyper-competitive markets, slow growth carries a specific danger. A competitor with institutional backing can simply buy market share, outspending a bootstrapped founder on marketing and infrastructure until they are overshadowed. While bootstrapping maximizes founder autonomy and lifestyle control, it limits the ability to defend the business in winner-take-all industries. To gain speed, many founders use the SAFE, the simple agreement for future equity. It was created to bypass legal fees and avoid setting a hard valuation on the company early on. The mechanic is simple. Investors provide cash today in exchange for a contract that converts into shares during a later funding round. SAFEs became popular because they carry no interest rates and no maturity dates, allowing for incredibly fast fundraising. This chart shows the initial cap table at 100% founder ownership. To protect early investors, SAFEs include valuation caps and discounts. When signed, capital enters, but the founder's shares remain unchanged. This new block represents the unpriced pending equity. Because the dilution isn't immediate, founders often fall into a trap, stacking multiple SAFEs one after another to keep growing without ever pricing an equity round. This accumulation of unpriced debt creates a massive looming obligation to future investors. This is known as SAFE overhang, a hidden compounding dilution. When the company finally reaches a priced Series A round, every SAFE converts. The founder's slice of the pie shrinks rapidly, making room for all those early investors at discounted prices. Thoughtfully, SAFEs provide extreme early velocity, but they exact their toll through unpredictable and aggressive ownership loss down the road. Companies with strong traction eventually move to priced seed and Series A rounds, where they raise millions from institutional venture firms. This stage requires handing over preferred shares, formal board seats, and specific investor rights, like pro rata and liquidation preferences. The result is a massive capital injection, but that money is strictly earmarked for aggressive expansion and the hiring of an executive team. The company evolves into a rigid, highly scalable corporate machine. The focus shifts from experimentation to hitting strict KPIs and following a disciplined product roadmap. This is the VC treadmill. Growth expectations compound aggressively every quarter, and the company must accelerate just to stay in place. For institutional investors, the only acceptable outcomes are a massive IPO or a lucrative acquisition. The treadmill does not stop for moderate success. Taking priced institutional capital means permanently sacrificing the option to run a stable, profitable small business in favor of chasing winner-take-all scale. Effective strategy requires matching the nature of the business to the correct financial tool. This quadrant chart maps the decision. The vertical axis tracks the capital needed for scale, while the horizontal axis tracks market dynamics, from profitable niches to winner-take-all competition. Venture capital operates on the premise that the smaller slice of a massive pie is more valuable than 100% of a tiny one. Founders building AI or deep tech hardware usually land in the top right quadrant. Massive compute and infrastructure costs make SAFEs and VC funding a requirement. In these fields, severe dilution is a mandatory cost of market entry and survival. Specialized consulting firms and niche SaaS products belong in the opposite quadrant. In high-margin, specialized markets, venture capital can be counterproductive. The pressure for hypergrowth can break a business model that thrives on stability and high-touch service. For these builders, bootstrapping remains the optimal path to preserve autonomy and harvest long-term profits. Startup media hype often prioritizes the size of the raise over the health of the business. Long-term viability depends on matching the funding strategy to the founder's specific endgame. The right choice is the one that leads to the intended destination.